Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Processa Pharmaceuticals.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
All right, so when we're looking at a company like Processa, it's immediately clear this isn't, your standard PE ratio kind of analysis.
Not at all.
This is a pure clinical stage biotech. So you really have to look at the whole investment story through the lens of R&D success, not what they're selling today.
Exactly. I mean, the whole mission here is to figure out if the massive risk that comes with this kind of company is worth the potential reward.
And the balance sheet really tells that story, doesn't it?
It absolutely does. It just screams development stage. If you look at the 9 months ending Q3 2025, they posted a net loss of, $10.2 million?
And that cash burn is up a bit from last year.
It is, yeah, but that just reflects them spending more on their key programs. They're pushing hard for those big beta readouts. So they're in the business of proving a concept, not selling a product yet.
Which means the stock's value right now is all potential. It's totally option-like.
Right. A lottery ticket, almost. If the data hits, the valuation could just, explode. A massive step change.
But if it fails,
Poof, the value just evaporates. Which makes their financial runway, their cash on hand, absolutely critical.
and on that point, they have been raising money.
They have. They pulled in $10.6 million in 2025. It was a mix of public offerings and a strategic investment. That capital is foundational for them.
It gives them more time.
It extends their operating timeline, gives them the liquidity they need to push their two big assets, NGC Cap and PCS 499, through phase 2.
Okay, but let's pause there on the financing, because they're doing something pretty unusual.
Crypto strategy.
Yeah. They're talking about a cryptocurrency treasury strategy to fund R&D. I mean, from an investor's point of view, isn't that a huge red flag?
That's a very fair question.
It kind of screams desperation, like they can't raise money the normal way.
And look, you're right to be skeptical. In the past, that kind of move would signal deep, deep trouble. But management is framing this very differently.
How so?
They're explicitly saying it's a way to get more financial flexibility and, this is the key part for shareholders, to reduce dilution.
I
mean, in this industry, you're constantly seeing these follow-on offerings that just crush existing shareholders. So any strategy to avoid that, even an unorthodox one, is actually pretty interesting.
So it's a trade-off. You're weighing the weirdness of the funding source against the benefit of not having your stake diluted down the road.
Precisely. It shows they're at least thinking about protecting equity value, which you don't always see in early-stage biotech. But at the end of the day,
It all comes back to the science.
it all comes back to the science.
Yeah.
The treasury strategy won't matter if the drugs don't work.
Okay, let's pivot there then. The science. Their core focus is oncology with this next-generation cancer platform, NGC. What is this, and why is it supposedly a better mousetrap?
So the NGC platform is really built on sophisticated regulatory science. They're not inventing brand new chemo drugs from scratch.
Right.
They're taking existing proven chemotherapies and using their own method to optimize how your body processes them.
Like fine-tuning an engine.
That's a great way to put it. Think of it like a tool that's really effective but creates a lot of toxic waste. They're trying to refine the process to get all the good stuff and minimize the bad.
How does that work chemically? Can you break that down?
Sure. So when your body breaks down a drug, you get metabolites. With chemo, you have anabolite metabolites, which are the ones that actually kill the cancer cells.
The good guys.
The good guys. And then you have catabolite metabolites. They're often inactive, but they cause all those terrible side effects. Their platform basically modifies the drug's metabolism to push everything towards the helpful anabolites and away from the toxic catabolites. They're trying to widen that therapeutic window.
More killing power, fewer side effects. That's a concept anyone can get behind.
Right.
What's their lead drug doing with this?
That would be NGC Cap. It combines their drug, PCS 6422, with capecitabine,
Which is a huge, widely used chemo drug.
a cornerstone, especially in breast and colorectal cancer. But its biggest problem is the dose-limiting toxicities. The most famous one is hand-foot syndrome.
Right, which is awful. It forces people to stop treatment.
Exactly. So NDC Cap is designed to let patients stay on that effective dose for longer by cutting down on that specific toxicity.
And have they actually shown this works in people?
Yes, and this is where the story starts to get pretty compelling. The preliminary phase 2 data has been very encouraging.
Okay.
In the first 16 out of 19 patients with metastatic breast cancer, the data showed exactly what they hoped for. significantly higher exposure to the active cancer-killing metabolites.
And critically, what about the side effects?
No increase in severity. That's the key. More of the good stuff without more of the bad.
Wow. So that's not just a win for one drug. That's like a proof of concept for the whole NGC platform.
That's the bigger picture, yes. If it works for capecitabine, you could potentially apply this platform to dozens of other legacy chemos that are limited by toxicity.
The scalability could be enormous.
It could be, and what's more, their regulatory path here is pretty clever. It's designed under the FDA's Project Optimus framework.
What does that mean?
It means the FDA is encouraging them to focus on dose optimization and quality of life early. Because they're just improving an existing known drug, this could actually shorten their path to approval.
A faster track. That's a huge advantage. Now, they're not just an oncology play. They have this other big shot on goal in rare disease.
They do. They're not putting all their eggs in one basket. Their second key asset is PCS499.
And what does that target?
It targets a condition called focal segmental glomerulosclerosis, FSGS. It's a really progressive and devastating kidney disease, often leads to complete kidney failure.
And what does the treatment landscape for FSGS look like?
Shockingly empty. I mean, right now, there are 0 FDA-approved therapies specifically for FSGS.
0.
0. It is a massive unmet medical need. So by going after this, PCS499 is positioned for potential orphan drug status.
Can you just quickly remind our listener what that first-mover orphan drug advantage really means commercially?
Of course. It gives them 2 huge things. First, regulatory perks like an accelerated review process and 7 years of market exclusivity if they get approved. No generics.
Okay, and the second thing?
Pricing power. This is the big one. Drugs for rare diseases with no other options can command, premium prices. PCS499 is basically a safer, optimized version of an older drug designed specifically to capture this high-value market.
And it sounds like the scientific community is taking it seriously.
They are. The design for their study, an adaptive phase 23 trial, got accepted for presentation at the big ASN Kidney Week 2025 conference. That's a real signal of credibility.
So, okay, we've got 2 high-potential assets, but man, the stock chart tells a very different story. The investor experience here has been brutal.
It's a tough picture to look at. The stock is down something like 88% over the past year.
88%?
Yeah. That kind of drop tells you there's been a massive institutional washout. It signals deep, deep skepticism from the market about their ability to execute.
But that's what creates the asymmetric rebound profile, right? The valuation is so crushed that any good news can send it flying.
That is the bull case in a nutshell. The lower the base, the higher the percentage gain on good news. But we have to talk about why that skepticism exists.
Right. It's not just the cash burn.
No. They've done multiple reverse stock splits in the last year, a 1 for 20 and a 1 for 25. Both were just to stay listed on the NASDAQ.
And for an investor, a reverse split always feels like a failure. Like you're just shuffling the deck chairs on the Titanic to avoid getting delisted.
It's a very painful thing for existing shareholders, for sure, and it really underscores the risk here. So the bet is clear. You're betting that the clinical success will eventually overpower years of this financial volatility.
And overcome the deep skepticism that those splits created.
Exactly. The execution risk is still the #1 bear argument. These are small trials, 60 to 90 patients. Things can go wrong.
But at this valuation, you could argue a lot of that risk is already priced in.
Yeah.
And we haven't even touched on the M&A angle.
Right. The M&A optionality is kind of the cherry on top if the data hits. A big pharma company wouldn't just be buying one drug.
They'd be buying the whole platform.
The whole NGC platform, proven, ready to be applied across their own portfolio. And with PCS499, they'd instantly get that first mover advantage in a huge, untapped rare disease market. Both become really attractive targets after strong phase 2 data.
So let's make this actionable. What's the timeline? What are the catalysts people should be watching over the next few quarters?
For NGC Cap, the timeline is getting pretty tight. They're on track to finish enrollment for their 20-patient interim analysis cohort by the end of Q1 2026.
That's the big one.
That's the massive binary event for oncology. But even before that, any little safety or PK updates in the next, say, 1 to 3 months could give us some early signals.
And what about the kidney disease asset and the corporate side?
We should get more visibility on PCS499 at that Kidney Week conference in 2025. And any updates on how fast they're enrolling patients will be key.
Okay.
And then corporately, we need more clarity on that crypto treasury strategy. If they can actually roll out a plan that is less dilutive, that in itself could be a huge positive catalyst showing they're getting their financial house house in order.
So this is a really complex case. It's the definition of an asymmetric, high-risk, high-reward setup.
It is. The whole thesis just comes down to execution on the science. Can they produce phase 2 data that validates their platform?
And if they do,
Given how beaten down the stock is, success in either cancer or kidney disease offers this high convexity scenario, just massive potential upside from a rock bottom base.
right,
But you have to go in with patience. This is a 12 to 24-month bet on data.
a critical timeline to keep in mind. You're betting on the science, winning out. Well, if you want more analysis like this, be sure to subscribe, like, and leave a comment below. We'll see you next time on Smart Wealth with Joshua.